Hey everyone, welcome to this explainer. Today, we're diving straight into the invisible forces, financial claims, and intricate power dynamics that literally run the corporate world.
Think about it for a second. Who really controls a corporation? Is it the people who fund it, the folks running it day to day, or the customers who actually buy the products? It's a fascinating question, right? And answering it takes us way beyond the boardroom and straight into how businesses actually survive, thrive, and manage some pretty massive risks on a daily basis.
So, here's our roadmap for today. We're going to look at debt versus equity, check out conflicts of interest, map out the stakeholder ecosystem, talk about governance theories, and wrap up with evaluating ESG.
All right, let's jump right into part one, the financial core, debt versus equity.
At the absolute center of every corporation is its financial engine, and it's powered by two totally distinct groups of capital providers. You've got lenders putting up debt and shareholders providing equity. If you look at the tenor and return potential rows here, the difference is huge. Equity has an indefinite tenor with theoretically unlimited return potential. Debt has a strict, finite term, and its returns are hard-capped at the promised interest and principal. So even though they're drawing from the exact same pool of company cash flows, they are playing two completely different games.
To really see that equity potential in action, check out the pink shaded area on this graph. It plots firm value against the payoff. Once a firm's value crosses that vertical dotted line, meaning it surpasses its debt obligations and hits solvency, every single extra dollar of value created goes straight to the shareholders. It's visual proof that if a firm absolutely crushes it, the shareholders have a theoretically unlimited upside. The sky's the limit.
Now compare that to the debt holders payoff, which is that dotted blue area. Notice how it just stops growing. As soon as the firm's value hits that debt line, the debt holders payoff goes completely flat. Their returns are totally kept. Literally, no matter how much the firm's value skyrockets after that point, the lenders aren't seeing an extra dime.
Moving on to Section 2, Financial Conflicts of Interest.
So, because these two groups are pulling from the exact same cash flows but have wildly different risk and return profiles, you naturally get this inevitable friction between them. Shareholders, who are protected by limited liability and chasing that unlimited upside, often push for much riskier projects and higher financial leverage. They want the company to take those big swings, right? Debt holders, on the flip side, are almost entirely risk-averse. They just want the company to ensure safe, steady cash flows so they get paid back on time. They absolutely hate big swings. And honestly, this tension dictates pretty much every major financial decision a company makes.
Okay, let's zoom out a bit for Section 3, the stakeholder ecosystem.
In reality, a company isn't just some financial piggy bank split between investors and lenders. It operates in this massive, highly complex ecosystem. Take a second to trace the lines on this flowchart. It's a real aha moment showing how interconnected everything is, from the board of directors acting as agents for the shareholders, all the way down to the contractual bonds with customers and suppliers. It's definitely not a straight line of command. It is a dense web of competing interests and critical dependencies that management has to constantly navigate.
And what makes it tricky is that every single group in this ecosystem competes for resources based on its own unique motivations. Managers, they're looking at compensation and career growth. Employees want job security and a safe place to work. Customers demand safe, high-value products. Suppliers need timely payments just to survive, and governments are demanding compliance and tax revenues. The company basically has to keep all these plates spinning perfectly all the time.
And when one of those plates drops, the fallout can be severe. Take the KLD Marine case from our source material. They're a small boat manufacturer in a remote town. Let's say management decides to borrow heavily just to pay out a massive one-time dividend to shareholders. Sounds great for the shareholders, right? But that huge spike in debt suddenly puts the entire company at risk of financial distress. And who ultimately pays the price? The highly specialized welders employed by KLD, whose livelihoods and job security are now on the chopping block, all to fund that shareholder payout.
This brings us to Section 4, shareholder versus stakeholder theory. So when these inevitable conflicts pop up across the ecosystem, whose interests should actually win out? Well, for a long time, the dominant perspective was shareholder theory. This essentially dictates that managers and the board must act primarily and often exclusively to maximize returns for the owners. Under this framework, you're only considering the needs of employees, customers, or society if ignoring them would directly hurt the shareholders' bottom line. It's a very laser-focused profit-first mentality. Stakeholder theory, on the other hand, pushes for a much broader focus. It argues that corporate decision-making has to balance the needs of everyone involved in the ecosystem.
The logic here is pretty straightforward. Ensuring long-term stability and maintaining healthy relationships with your employees, your suppliers, and your community is ultimately what creates a sustainable, resilient business over the long haul.
All right, last up, Section 5, Evaluating ESG Risks and Opportunities.
Today, modern investors don't just debate these theories in a philosophical sense, they actually formalize this balancing act by using ESG factors to evaluate these massive corporate ecosystems for long-term viability. Analysts are out there carefully weighing these three pillars: environmental impact, social factors, and governance structure. So they're looking at the whole shebang, everything from a company's carbon footprint and labor practices to how independent its board is and whether executive compensation actually aligns with the company's long-term health.
And hey, if you think ESG is just some feel-good corporate buzzword, the financial stakes of ignoring it are absolutely visceral. Take a look at this number, $3.9 million. According to the source material, that is the average cost of a data breach. That falls squarely under the social risk factor of the ESG umbrella, specifically the mismanagement of data privacy.
We've seen this reality hit incredibly hard in recent years, too. Remember Equifax? Lax cybersecurity led to a breach affecting over 140 million people, costing the company hundreds of millions of dollars. Or Meta, who got slapped with a staggering $5 billion US government fine for sharing user data without consent. These aren't just bad PR days, folks. These are massive, balance sheet destroying liabilities.
So, the really crucial takeaway here is that strong governance and stakeholder management aren't just nice ethical ideals to aspire to, they are cold, hard business imperatives. Effectively balancing all these competing interests directly results in much better control processes, improved operational performance, and gives the company a clear, measurable competitive advantage in the market.
As we wrap up this explainer, I want you to look around your own life. Consider the delicate ecosystem of the brands you rely on every single day. Ask yourself, how does a company that you admire balance the competing interests of its investors, its employees, and the environment? Do they lean more towards shareholder theory or stakeholder theory? It's an incredibly complex balancing act, and, as we've seen today, getting it right is the ultimate key to a corporation's long-term survival. Thanks so much for joining me to explore this today.